Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome to the Australian Finance Podcast. I'm your host, Kate Campbell, and today I'm here with my wonderful colleague, Mitch Sneddon.
Hey, Kate. How you doing?
I am doing very well, and I'm very excited to talk to you about active, because we talk about this debate, active and passive, all the time. And you've got a bit to add here because you don't think it's one or the other. You think that we can use both.
You can have your cake and eat it too. But I guess we'll break down today really what it means to be an active investor, when you might consider using an active investor and an active investment approach. Just really kind of break it down when you might actually just choose to use get someone else to actually do the investing for you.
Yeah. And from all your experience working behind the scenes in the investment industry, you've seen a lot of good stuff and a lot of the bad stuff. So we're also going to share your checklist for picking an active product, which I think is really important because there's so many different options out there. And while we talk about ETFs and simple, maybe your A200s or your VASs on the podcast a lot, we don't talk about active investments that options often. So I think it's going to be really good to break down what should you be looking for, what questions should you be asking when you are looking at an active product.
Yeah, it's really important because there are far more managed funds out there in Australia than there are ETFs, like hundreds of managed funds. And there's actually so much of Australia's wealth is actually in those management funds. I can't remember the exact stats. I remember Owen talking about it on a Rask Live episode, and he broke down how much is actually in managed funds in Australia compared to ETFs, and it dwarfs ETFs. And so ETFs have definitely taken the marketing headlines and a lot of the press, but still a huge percentage of Australia's wealth is tied up in managed funds, most of those active.
When we talk about active, and in the context of this episode, what things might we be discussing?
Well, let's have a look at what is truly active versus passive. I take a very traditional approach to it. Anything that is not passive index tracking. So when I say index tracking, I mean the real traditional ones, say be the ASX 200 or 300.
IVV, tracking the US.
Yeah, the S&P 500, the IVV, which is the stock code for the iShares ETF that does that. MSCI All World Index. So these really pure traditional indices, when you have an ETF that tracks one of those, I call that a truly passive, when it's a market cap weighted indices. Now, as soon as you step away or put in some other rules in place there, even if it is in a passively selected, like rules-based ETF, as soon as it steps away from that, you can say it traditionally moves away from being purely passive because someone has put in a set of rules to pick those individual holdings. It might not be an actual fund manager who is analyzing businesses and only holds like 20 or 30 stocks in the ETF, because we can get actively managed funds listed on the market in essentially an ETF wrapper. But it's just anything that diverges basically from that pure market cap indices.
Yeah. So you can have what looks very much like an ETF, but it's just got a few extra rules and things added, which might have very little human involvement. Or you could go all the way to a very niche, actively managed fund where you invest directly through them and they don't often tell you what's inside the box there, and they're picking and choosing the individual companies there.
Well, I'll take a step back there because they are listed on the stock exchange. This is the good thing about that even if it's a managed fund listed on the ASX through and the package of an ETF, let's take out, I used to work at the Intelligent Investor, and they've got 4 listed active ETFs, right? And because they're essentially managed funds listed on the market in the wrapper of an ETF, because of that listed nature, at the end of each month, they actually have to tell you every single holding in the ETF. So that does actually come with that added level of transparency. Whereas if you were to look at a lot of managed funds, you go out and, although if you look at, like, say, a lot of small cap managed funds out there, they might only show you the top 5 holdings, and they might be holding 30 stocks, but you only know those top 5, and that's a static PDF that they produce each month. Whereas if with the listed managed funds, you do actually have, at the end of each month, the ability to go on the ASX or go look it up through your broker and see a full list of the stocks that they hold.
It's quite different because I've used an actively managed fund that's not listed on the ASX for quite a few years, and I only know what they tell me in the report. I don't actually know where every dollar I've invested has gone. I just know it's in international companies that follow this philosophy, but I don't know down to the dollar where all my money is.
Yeah, and that's kind of how it has been historically. So you do have to have a certain amount of faith and trust in the manager and understand the manager's process. And that's going to be in a few of the little dot points that we talk about later about how I, look and think about active managed funds when I am checking them out.
I know one of the questions you get a lot when you're talking to Rask investors is, when would you use active and when would you use passive? Are there any circumstances that pop up for you there?
A lot of people, in the context of what we do, the discussion pops up a lot when they're taking a core and satellite approach. Now, I'm sure you've probably done heaps of episodes on core and satellite.
I think we can link a few that Owen's done in the show notes.
Yeah, good. So it comes up a lot when we're talking core and satellite. So people would look at, say, what we do, really simple ETF portfolios as their core component. And then they might take 20% or 30% of their portfolio and invest in satellite, where they might handpick individual managed funds, thematic ETFs, or individual stocks. So it comes up a lot in that context. And there are some instances where, say, going off the ASX and going to an unlisted managed fund does make sense. Especially if you want to target like small cap stocks. So if you want a fund manager who specializes in investing outside of, say, the ASX 100 or 200, there are actual rules for listing an ETF on the ASX, liquidity rules, and those funds just aren't suitable to be on the ASX. The liquidity's not there, and so you need a manager to be able to get really exposure.
Yeah. Yeah, I know some of those small companies that are listed on the ASX, some days not a single person makes a buy or a sell.
Yeah, exactly. It doesn't mean they're not good companies by any means. It doesn't mean they might not be worth investing in, but liquidity just isn't there. So they can't be in an ETF structure. Additionally, there's, some people might want to invest in private markets. Or like private companies and through private equity. And so that structure isn't really suitable because, once again, you do not have shares trading every single day on the ASX.
Wonderful. Now, you put together a bit of a checklist for when we're looking at an actively managed investment, because there's a lot more questions that we should be asking.
Yeah, so essentially whenever you're looking, and you maybe do this knowingly or unknowingly, with investing, when you decide to invest in something, you're actually also deciding not to invest in something else. And so by looking away from the stock standard indices, which are incredibly difficult to beat, so by saying that you're actually going to pick this other investment option, you are knowingly or unknowingly saying to yourself, I believe this will do better than the passive alternative.
Right. Yeah. So there is that opportunity cost.
Yeah. It's a trade-off
in there.
Yeah. And so those bog standard indices are really, really difficult to beat. Like if you look up, and we can link to this in the show notes as well, the SPIVA reports, SPIVA from the S&P, they give you reports on, through the different asset classes, the percentage of managed funds that actually beat those stock standard indices. And it's really eye-opening. Generally speaking, on Australian equity funds, you've probably got around 70 to 75% that do not beat, say, the ASX 200. And that actually increases when you go international. So you've got close to over, like, say, a 15-year time period, close to 80% of international funds don't beat the industry standard benchmark, which I think, and I'll have to double check the report, but I think in that might be the MSCI All World Index. So as soon as you select an active fund, you are saying, I do not want this pot of money invested in the passive alternative. And that could be for a number of reasons. For example, I do have in my own investing have a mixture of passive and active. My active side of things in Australia, for example, is a handful of Australian small cap managed funds. And I'm making I know that the performance will be different to the to the indices, but I'm making a conscious decision there because I want that exposure. I do think we have some fantastic small companies in Australia that can grow and outpace that indices, but also I want some of my capital actually supporting the next best up and coming and brightest companies, brightest prospects in Australia. I like that idea. And so that actually aligns with my values rather than pouring more money into the big four banks and BHP. You know, I like the idea of some of my capital being put to work there.
So you've really understood that I want to put a portion of my portfolio into Australian small companies. I, for whatever reason, think that active is the way I want to go here. So you've used that portion. Instead of going passive, you've decided to go active there.
Yeah, that's correct. So if I have a look at the indices that would be classified, I guess, as the passive small cap index here in Australia, the small alts, there's a lot of stuff in there that I probably wouldn't want to buy. It's, junior resource companies, like junior mining companies, things like that I just would rather not hold. And so for me, if I'm wanting to diverge, like not do that, then an active strategy is the one that I'm taking.
So step one for people is really understanding what they're looking for. Does active make sense here for their portfolio, or would they be better off with a ASX 200 index fund or whatever role you're looking to fill?
Yeah, exactly. So if you look at like large cap Australian funds and large cap international funds, they really do have a difficult time of beating the market. So you may be, and that's because they predominantly, it's because of the fees. The average underperformance is really close to the size of their fees. So just to get back to square, that active fund needs to actually already outperform just to earn back the fee. So yeah, it's really, really difficult.
So you've introed me nicely to number 2 on your checklist, which is what are the fees? Because there's often slightly higher fees or significantly higher, depending on the fund fees involved in this space.
Yeah, I didn't even know that was number 2, but it was a good segue by me. So this is really important because, as I just mentioned, a lot of research out there indicates that these active funds actually underperform the industry standard benchmarks by the cost of their fees. And so when I'm having a look at something, I'm looking to see if the fees make sense. I can go out there and invest. If I want to invest internationally, say in the S&P 500 or invest in US stocks, I can get IVV, which is iShares, the iShares S&P 500 ETF, at a management expense ratio. So that's all the costs inside it at 0.04% per annum. Right, that's next to nothing. Right, to get that exposure. So if I'm looking at an international any fund, I'm looking at the fees, and I'm not going necessarily immediately for the cheapest, but are they just roughly in the ballpark? Fees have been coming down dramatically. Like, it's incredibly rare these days to see something at 2% or even something over 1%. So they have been coming down. I'm then actually also looking at to see if there's any performance fees involved. A lot of people say to you that they don't mind paying performance fees, but they do really eat away at your return. So I'm looking to see if there's any performance fees. Ideally, I prefer them not to see the performance fees. But if they are there, I'm then scouring through the PDS to see the term high watermark. And that's really important because essentially when a fund underperforms, it doesn't pay you back the performance fees. But a high watermark ensures that they can't underperform and then charge you a performance fee again to get you back to square, essentially. So that's really, really important little bit of jargon when looking at a PDS.
Yeah, so product disclosure statements, everybody's favorite document. I'm sure everyone listening has read their product disclosure statement for their super fund. But when you're looking at active products, it's even more important because there are different layers of fees that are a little bit different to what we're used to with a normal ETF that we need to look at.
Yeah, exactly. And also, say if it is an active ETF on the market, there will be a buy-sell spread involved there as well, which is generally a little bit higher than what you would see for a passive ETF. So just little things that all add up that are going to come out of your investment and going to make it a little bit harder for that active investment vehicle to outperform the bog standard benchmark, which you can get really, really cheap in an ETF.
Yeah, and part of the reason why the fees are often higher is with an actively managed fund, they may be employing a whole team of analysts that are doing all the research and the deep dives and going out and meeting people from companies and doing all this sort of stuff and putting the research together.
It costs money to run these things, and the more exotic how you found the word exotic there, funny, Kate. The more exotic the...
I'm just imagining ETFs with all sorts of islands and...
Wow. So I've got a mate of mine works for, he's an analyst for an emerging market fund, and they really have to travel. They charge a performance fee. They charge a reasonable management fee. But I know one of their investments is a supermarket chain in Poland. And so off they go. And they are over there, checking out their investments there. And he would regularly go to South America to have some boots on the ground research, and that comes at a cost.
Yeah.
That comes at a significant cost.
You mentioned reasonable, though. What might be reasonable?
A reasonable management fee. In an active land, if you're getting around 1% or less, it's okay. Yeah. It's most will be 1% these days.
So if we had 10,000 invested with them, that'd be $100 a year.
Yeah.
And so you've got to think about that over a long period of time. These fees, as you invest more,
they compound.
It compounds.
Yeah. Often, if you then have a couple of $100,000 in this, it'll be the largest bill you're paying. But you never actually have to physically fork out money from your pocket to pay it. So a lot of people don't think about it.
Yes. All right. Step 3 on your checklist. Who is the fund manager?
Yeah. So I think it's really important to step back and really understand the manager, the manager and the people and the process behind it. And I think it's incredibly important for people to understand the investment process, because it's fine when it's going up, but you need to understand what you're invested in, why you're invested in it when troubled times hit. Because unless you understand, you're not going to have that confidence to hold through a full market cycle and get those long-term returns. You're going to be chopping and changing. You're going to be your own worst enemy. And it might not be the fault that the manager's not skilled at what they do. It's just that whatever style or whatever sector or theme that they invest in might not be in favor. The investing's cyclical. And so unless you actually understand the manager and their investment process, you're going to have a pretty tough time when that happens.
Yeah. Just like if I had 10 companies in my portfolio and one did really badly one year because of a product recall or something like that, if they have a similar range of companies and that product does very badly, then that can really impact your portfolio returns that year.
And another thing I like to think of as well is, do my values align with the manager, and how do they communicate as well to me as an investor? I might be a really needy investor. I might need to be able to call them up and have a chat. I might be just a pure numbers-driven investor and just want to see a PDF of just some stats, and I'd be really happy with that. So do they communicate with you in a fashion that you're comfortable with? I think that's really, really important. And I also would love to ask them, like, if they're invested in their own fund as well, do they eat their own cooking?
Yeah.
That's really important. I remember a couple of weeks ago, Owen did an interview with a property manager, which I think aired on the Australian Property Podcast. We'll put a link in the show notes to this one. And one of the first things this manager said was he acknowledged that he was managing other people's money and what a privileged position that he was in, and he doesn't take that lightly. And if you go back and listen to so many of the fund managers that we've had walk through these doors before, geez, I'd probably say only a handful have actually come out straight out and said and recognized that they are managing other people's money.
And other people's retirement savings.
So it's a really important job.
Would there be any red flags that jump out to you of, this fund manager is not being transparent or not communicating or not going to respond to me if I have questions or concerns?
Yeah, just, I've reached out to so many managers in the past, and you might go through their standard kind of communication channels like the contact us forms and things like that, and you just never hear back from anyone. I hate that. It's terrible. And then one thing you can, maybe you don't have the chance to talk to, the chief investment officer of Magellan or something like that, right? But you can go through the product disclosure statement, and when coming back to these fees, you look at, say, if they do have performance fees in there, you can actually see how they're treating their investors by looking at what benchmarks they set for themselves. And so I've seen lots of managed funds out there, very actively managed, say, Australian small cap funds and things like that, where they actually set their benchmark as the RBA cash rate. And I just think that's rubbish. So you can kind of get a sense for how they might treat their investors.
Yeah.
Just by, are they fair and reasonable?
Okay. That's a good one. Number 4, what is the active fund actually investing in?
Yeah, that's really important. It comes back.
Do you know what's going on?
Do you know what's going on? That comes, I think I kind of, I maybe went a bit too far in my previous answer by going into this, because are you comfortable with the people in the process here?
Yeah.
Do you understand what they're invested in, why they're invested in it? So when you actually see a stock pop up in their top 10 holdings or whatnot, you can say, yes, I understand how this fits in with the rest of the process. So that's really, really important.
Yeah. Read their quarterly and monthly reports for the last few years, see what they've talked about, see what they've invested in, what they've bought and what they've sold and why.
Yeah. And now I will regularly do a search on YouTube because, we're not the only podcast in town. There's heaps of
people
podcasts.
Get around.
And there's every chance that the manager that you're keen on or are looking at has done a podcast or done a video, or one of their presentations is up on YouTube. Jump on it and just listen to them.
All right. Finally, last but not least, step number 5, looking at the performance and track record of the fund. And interestingly, you said this was not the most important thing.
No, I put this at number 5 because I think that's probably where it comes in. Like, if you're not comfortable with the people, you're not comfortable with the process, you think the fees are pretty average, then don't invest.
Just because it's had a stellar 12 months.
There's a report generated, I think it's also by the S&P, and it's about the persistence of returns. Once again, I'll try and find it and we'll put it in the show notes. The show notes are getting very long for this episode, but I'll try and find this particular report. And I've written an article on it in the past, and it essentially shows that today's top performers are statistically most likely to be tomorrow's bottom quartile performers. And the bottom quartile performers today are statistically most likely to be tomorrow's top performers. So So by ranking these fund managers by best performing, like over, maybe a 12-month period or something like that, and just picking the top couple, you're doing yourself an absolute disservice. Okay, so there's probably reasons why, like that, talking about the cyclical nature of investment markets, that they're at the top. So you, by just purely focusing in on that, you're more likely to actually pick tomorrow's bottom quartile. Doesn't mean it's a bad fund, but it just means you need to hold on.
Yeah.
And hold for the long term. So, but it is also important to have a look, because it does demonstrate, over a long period of time, it can demonstrate the actual the proof of the approach.
Yeah, and we've both spoken to and seen many investors in the past who will look at their portfolio once a year and go, oh, I've underperformed this year, whatever they expected to do. They're going to pull out all of their money and jump into the next best fund that's had heaps of hype in the media, that's done really well over the last 12 months. And they won't look any further past 12 months. They're just thinking 12 months at a time.
Yeah, it's jumping from fund to fund like that and crystallizing your losses or whatnot or a tax event is a great way to actually destroy wealth and not build it and create it. You're not letting compounding do its thing. You're disobeying Charlie Munger's number one rule, which is not to interrupt your compounding unnecessarily. So it's something that I definitely say to avoid.
Now, with all of this in mind, we've got our checklist. We know what role active could play. You're our in-house expert on Rask Invest. Are you able to explain a little bit about our take on active investing?
Yeah, so I was having this conversation just yesterday with someone. I kind of called it we're active passive investors. So we put together portfolios predominantly of passive index tracking ETFs. And on the active side of it, we decide how much goes into each one. We decide what percentage goes into US shares, Australian shares, cash, bonds, etc. We'll manage the cash flows coming in from people who are, contributing to their account and saving. We'll manage the cash flows coming in from distributions and decide where they go. So we can continuously maintain the right balance in a portfolio. And then we'll rebalance the portfolios as and when we need. So that's not on a preset time period, like a quarterly rebalance or 6 monthly rebalance. I often joke that, markets don't operate to a set schedule. But we have more of a weightings trigger when our growth assets diverge so much from our defensive assets. We'll then rebalance the portfolio to maintain the risk profile of the portfolio. And so whilst we invest in passive investment vehicles, we take an active portfolio management approach to that. But it's really important not to get too tied up on that word active. We're not doing something every day. We're not doing something every month. We might not be doing something every 6 months. We might not even actually do something for an entire year. It's all driven by the weightings between our asset classes.
So you're getting the low cost side of passive investing, but you're also getting the human oversight and management side of active investing. Yeah.
And something that Owen and I think about a lot, and this is actually something to consider with an active approach if you're going with there's some managers out there that are hyperactive. The more you transact, you've got tax events going on. So in a fund, you won't see them, okay? But you'll actually have to pay them at the end of the day. So you'll get your tax statement. Your distribution will be made up of any realized income from dividends and from capital growth. That's passed out to you as a distribution. But yeah, you're going to have to pay tax on that. And so an active manager, someone who's really active, can be actually creating a lot of tax events. So that's something that, and that doesn't actually get written in to the performance figures of a managed fund because the fund is not the taxable entity. The unit holder is. And so the fund will put up these performance numbers, but a lot of the time all the time, they're not after tax. And so that's something that Owen and I really think about a lot when we're managing these portfolios.
What type of investors are using Rask Invest?
This definitely wasn't the intention to come on and just talk about Rask Invest for anyone who's sitting there going, this just sounds like an ad. But I would say, and this is for people who are looking at it at any managed investment solution, not just us. I've been doing this for a while now, so there's a lot of common traits, no matter who it is going to anywhere. There's three things. You need to invest successfully. I think you need the time, the skill, and the will. So the time, we have a lot of people. I've had people come to investment managers because they might have the knowledge and the capability. They'll be perfectly capable of, say, handpicking a couple of ETFs themselves, and buying them and holding them. But they actually don't have the time to put in for the research. They don't have the time to actually open up the brokerage account. They might not have the time then to, automate and set up all their automations and have it all ticking along and then collate all their tax details and all the statements, etc. And if you don't have that time, and I see this a lot, someone will reach out and have a chat with me, and then they say, hey, we're going to do this ourselves. I'm like, fantastic. Yep, off you go. Here's a whole lot of education that we have to help you do that. I'll check back in with them and I'll say, hey, how you going? And a few months later, and they're like, kind of haven't started yet. Life gets in the way. So, if you could be growing your career, you could be growing your family, you could be retired and think you're going to have all the time in the world on your hands, but then all of a sudden you're volunteering, you're going out to lunch, you're going on 15 cruises, you're doing whatever.
Hey, don't knock cruises, Mitch.
I know
they're fantastic.
I know you're a fan. But you're far from retired, Kate. So the time poor, I think, should consider a managed investment strategy for them. Then there's the skill and the will. So you need to put in the time to understand and learn. Even if it's just ETFs, learn how they work, learn what's in them, learn how to put together a portfolio of them. Do a Rask course or two. But then I find like a lot of people go down that rabbit hole and are really excited for a while.
For a while is the important.
Yeah, that's the thing. And this isn't a knock on them at all. It's just they get down that rabbit hole. I've been down 1,000 rabbit holes, and I know what it's like. You think, I'm going to do this. I'm going to blah, blah, blah. I've got a ukulele in the cupboard to prove that I went down a rabbit hole and
we've all been there
and thought, hey, I'm going to get right into this. At the end of the day, they go, hey, I understand it. I know it's actually a really important thing I should be doing, but I just don't care. I'm just not interested. And so there's absolutely no shame at all in reaching out to someone to do it for you, because you know it's important. You're happy to pay a reasonable fee for the service, and you can grow your wealth on the side with someone that you trust, in an approach that you've done your research on and you appreciate, and you get on with the rest of your life.
Yeah, and even just having a bit of that knowledge means that if you are getting someone to help you with it, you can just ask them better questions. You know what to look for, you know what to call them out on, you know how to make sure that you're in a product that's right for you.
Yeah, exactly.
Well, I think we've covered quite a bit today, Mitch. Just recapping your checklist for looking at an active product. So firstly, we're just thinking about what are we actually looking for, and does active make sense in this part of my portfolio? Second, looking at the fees. So the management fees, the performance fees, and looking if there's anything using the word watermark in that product disclosure statement.
High watermark. And also going back to, does the benchmark make sense? So I often will not compare. Sorry, Kate, I've hijacked this
That's
bit.
all right.
I often won't actually compare a managed fund to their own benchmark, especially if it's a terrible one.
Yeah, you actually find what's relevant.
Yeah, I'll go out there and say, okay, this managed fund, I'll go and see what would be, hypothetically, what would be the ETF equivalent of that managed fund, and I'll go out and compare it to that.
Thirdly, who is the fund manager, looking at how they communicate and their track record?
Yeah, exactly. So just making sure you're comfortable and there's a real alignment between your values and the manager's values, I think is super important.
Ask them lots of questions. They're going to answer. And if they don't, they're probably not the right person for you. Fourth step on our checklist is understanding what the fund is investing in, as much as you can, finding what's inside and whether that's something you want to be invested in.
Yeah, and look, you go back and read heaps of read the old monthly and quarterly reports that they have. Go back and watch any webinars. So if you understand the process, right, that they say they're going to be doing, and then you can go back through.
Do they follow that process?
Do they follow it?
Yeah.
Like going, hey, that stock makes absolutely no sense as to if I run all of your supposed key criteria across this stock, it doesn't make any sense.
Mm.
And call them and ask them about it.
Yeah. And finally, lucky number 5, looking at the performance and the track record of the fund for more than 12 months.
Yes.
Ideally 5 to 10 years if they have it.
Yeah, exactly. I mean, Rask Invest, our service, has only just turned 6 months. And it's kind of a good thing that we're so young, because people can't judge us on that performance track record. They can't just scroll down and say, okay, they have to actually judge us on all these other criteria that I think are far more important.
Wonderful. And if people want to book a call with you to chat about Rask Invest?
Kate, they can just reach me at mitchell@rask.com.au. I'm sure these show notes are getting incredibly long, but there's going to be...
That's what they're for.
There'll be a link there to my Calendly where you can click on it and book a time that suits you.
Yeah. And if you are new to investing, we have a lot of free, really high quality educational courses so you can understand what shares are, what ETFs are, what property is, all of that stuff, so you can ask better questions. And I think that's really important.
Yeah, exactly. I mean, no one cares more about your money than you. So be informed. And, if you're going to go down this path, come armed with questions and have a chat to them first.
Wonderful. So in summary, active can be good if used correctly in certain parts of your portfolio.
Yeah, there is a place.
There is a place for active. It's not exclusively one or the other. Wonderful. Well, Mitch, thank you so much for joining me on the show today.
Cheers, Kate.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.